Welcome to this explainer. Look, if you're a CA student, audit can feel like this endless, overwhelming ocean of standards. But today we're going to completely decode SA 705 together. We're going to build a mental framework that makes modifying audit opinions so incredibly logical, you literally won't even need to open your textbook again for exam revision. Let's get into it.
Okay, here's our game plan for today. We'll start with why we modify the opinion, compare material versus pervasive, look at the 3 specific opinions, break down the decision matrix, talk about modifying the report itself, and finally, I'll share the QAD memory trick.
All right, Section 1. Why modify the opinion? First things first, we've got to establish exactly when an auditor steps away from a clean report. Under SA 700, everything is fairly presented, right? You've done your job, the numbers make sense, the report is perfectly clean. But SA 705? That kicks in when you've hit a major roadblock. Basically, one of 2 things has happened. Either there's a material misstatement, meaning the numbers or disclosures are just plain wrong, or you're facing a scope limitation, which means you literally cannot get sufficient appropriate audit evidence to even verify if those numbers are right or wrong. Let's move to Section 2, defining the variables, material versus pervasive. Before we can solve this whole modification puzzle, we absolutely must lock down our 2 primary variables. These dictate everything in SA 705. First up, material. The crucial point here is that a material issue is simply big enough to actually matter to someone reading the financials. If an error or a missing piece of evidence would legitimately change the mind of an investor or a bank looking at those statements, boom, it crosses the threshold. It's material. It's significant, sure, but it might just be isolated to one specific area.
But then we have pervasive. And pervasive is on a whole other level. This is a word you need to understand in your bones for the exam. An issue is pervasive if it's so widespread that it practically infects the entire financial statement. It's not just some isolated line item, it is fundamental to the user's entire understanding of a company's financial reality. Think of it like a systemic failure.
It's actually really fascinating to compare a localized error against a fundamental systemic failure. Think about an inventory overstatement of 50 lakh rupees. That is definitely material. It matters for sure. But it's isolated to inventory. So material, but not pervasive. Now imagine management uses a completely incorrect accounting framework that messes up the valuation of almost every single asset and liability. Well, the whole shebang is compromised. That right there is both material and pervasive.
All right, Section 3, the 3 modified opinions.
So let's see how those 2 variables actually create the 3 distinct modified opinions you need to deeply understand. First up is the qualified opinion. Think of this as your middle ground. There's definitely an issue. Maybe they calculated depreciation wrong on one specific class of assets, or you couldn't check the inventory at, say, 1 out of 50 warehouses. The issue is absolutely material, but it's not pervasive. It doesn't break the whole report. The rest of the financial statements are actually still okay. Now, when you see the words "except for" in an exam case study, or when you're writing out your own answer, pay super close attention. This exact phrase is an absolute favorite for ICAI examiners when they want you to identify a qualified report. You're basically telling the shareholders, hey, everything is true and fair except for this one specific thing.
Next, we escalate things to the adverse opinion. This happens when management gets the numbers wrong on a massive, fundamental scale. We're talking about misstatements that are both material and pervasive. Imagine they completely failed to prepare consolidated financial statements when they were legally required to. The errors are so deep, so foundational, that the document as a whole is entirely misleading.
And the lethal blow of an adverse opinion comes down to a very specific phrasing. Notice the exact wording you have to use. You are not saying "except for." You are explicitly, bluntly stating that the financial statements do not give a true and fair view, period. The numbers simply cannot be trusted. Finally, we have the disclaimer of opinion. Now, a disclaimer is totally different from an adverse opinion. With an adverse opinion, remember, you actually have the evidence to prove the numbers are wrong. But with a disclaimer, you're facing a massive scope limitation. You simply can't get the evidence, and the potential hidden errors could be both material and pervasive. Maybe management flat out refuses to let you see major records, or a huge server crash just wiped out a whole year of data.
For the exam, lock down this exact phrase. You are formally refusing to express an opinion at all. You aren't saying it's true and fair, and you aren't saying it's false either. You're basically throwing your hands up and saying, I have absolutely no idea because I couldn't do my job, so I do not express an opinion.
Moving on to Section 4,
the SA 705 decision matrix.
Okay, this is the climax of our explainer. We're going to plug our variables into this logical formula. This decision matrix concept is literally your master key. If you understand this, you can confidently answer any SA 705 case study they throw at you. Let's trace the logic. First, assume every issue here is material. I mean, if it's not material, we wouldn't be modifying anything in the first place. Now, consider the issue type. If you have a misstatement that is not pervasive, it's qualified. If it is pervasive, it becomes adverse. Simple enough, right? But what about scope limitations? Well, if you have a scope limitation that is not pervasive, it's also qualified. But if a scope limitation is pervasive, it becomes a disclaimer. Notice how a yes to pervasiveness splits your final result based entirely on whether it's a known error, a misstatement, or a lack of evidence.
Let's quickly test your understanding of the matrix with a classic ICAI exam scenario. Take a second to really think about this. A massive fire destroys all accounting records before you even begin the audit. Ask yourself, what variable does the fire represent? Is it a misstatement or is it a scope limitation? And is it pervasive?
So, did you get it right? Because the records are completely gone, you obviously can't verify anything. That immediately means it's a scope limitation. And because all the records are destroyed, it affects literally everything, making it totally pervasive. A material and pervasive scope limitation, that perfectly demands a disclaimer of opinion.
Okay, Section 5, modifying the audit report.
Once you've chosen the right opinion from that matrix, your job isn't quite done. You have to formally alter the audit report structure to reflect this new reality. The examiners want to see that you know exactly where to put your explanation. Whenever you modify, you absolutely must include a basis for modified opinion paragraph. This slots in immediately before the opinion section itself. It's there to explain the why. What's the nature of the issue? What's the quantifiable financial impact, assuming you can even calculate it? You have to lay out all the facts right before you deliver the final blow in the opinion paragraph.
Finally, Section 6, the QAD memory trick.
Let's lock all of this in with some rapid-fire revision tools to guarantee you snag full marks on exam day. Look, if you're writing a subjective theory answer on SA 705, the examiner is actively scanning your paper for these specific technical terms. Every single one of these keywords needs to be sprinkled throughout your answer. Don't just casually say the auditor couldn't find proof. No, you need to say the auditor was unable to obtain sufficient appropriate audit evidence, resulting in a scope limitation. You've got to speak the language of the standard.
And here is your ultimate safety net, the QAD rule. Whenever you sit down to read an SA 705 case study question, before you even process the story they're telling you, immediately write down this QAD rule in the margins of your paper. Q equals material not pervasive. A equals material plus pervasive misstatement. D equals material plus pervasive scope limitation. If you have this written down right there in front of you, your logic is never going to fail under exam pressure.
So I'll leave you with this final thought. If you uncovered a massive, systemic error tomorrow that alters the entire financial reality of a business, are you prepared to step up and confidently declare it adverse? Audit isn't just about ticking boxes, right? It's about holding the line on financial truth using a very clear, very logical set of rules. Trust the matrix logic we've built today, and remember, anytime these concepts start to feel a little blurry, you can always jump back to this explainer for an instant SA 705 refresher. No need to dig back through a massive textbook. Keep studying smart and go own those standards.